Okay, so we are November 16th. We're going to start talking about options today. Apologies for the background noise. Got the kids tonight, so it goes. So, and let me pull this up very quickly while we're waiting. Sorry, I should have done this before. Talk about the guru. Wait for that to load. Okay, so just let me switch the screen sharing. Now, the premise of this, if you've ever watched The Simpsons, is that
recording in progress.
Mr. Smithers, the assistant to Mr. Burns, is on vacation. So Homer is filling in for him, taking care of Mr. Burns, and he's basically screwing everything up.
It's my job to cook him breakfast, and I'm gonna cook the best damn breakfast he ever ate.
Donuts? I told you I don't like ethnic food. Here, tell me how my stocks did yesterday.
They all won.
What about my options?
Well, you can either get up or go back to sleep.
I believe I'll get up. Scrub harder. Got to get that layer of dead skin off.
Hold on. What did I do with my...
The
Give me 1
fangs
second.
today.
All right, now hold on. Now I've messed everything up.
Simpson? Simpson? Did you get that report on the accounting department?
Yes, sir.
There we go. Okay, sorry about that. Okay, so obviously the options we're going to talk about are a little bit different than that. It's not getting up or going back to bed. Anyone understand why that donuts ethnic food thing is in there? I never understood that. No? Okay. Anyway, in an option, so we talked a little bit about futures last 2 weeks. And there are some similarities between options and futures, and you can actually have options on futures, and we will talk about some of those. An option, much like a futures contract, has two parties to each transaction. The buyer of the option has the right to do something. The seller has the obligation. What is the difference between a right and an obligation?
An obligation meaning you have to do it, and a right meaning you get the option to, maybe?
Exactly. Exactly. If I have the right to free speech, am I allowed to go out and say what I want?
You're entitled to the free speech, but you're also entitled to the consequences of said freedom of
No,
speech.
we're not talking about constitutional law here.
Oh, sorry.
We're just talking about what a right means. I can go out and speak freely. Do I have to? No, I do not have to. That is the difference between a right and an obligation. If we had the obligation to free speech, you would be required to go out and speak your mind. What is worth more, a right or an obligation?
Obligation.
Thomas, you have the right to attend class every Wednesday. Brianna has the obligation to attend class every Wednesday. Which one is more valuable? Or which
The
one
right
which
is
one would you rather have, Thomas? Would you rather I say you have the right to attend this class on Wednesday nights or the obligation to attend?
For me, the right. For the class, it's better to have the obligation to make the students, but
We're just talking about for an individual, for you. The right is more valuable. Why? Brianna touched on it.
You have the choice.
Exactly. If you don't want to come to class, you don't have to. If you have the right. But if you have the obligation, well, then you have to come to class or something happens. You get a financial penalty or you fail the class or we all talk badly about you when you don't show up, something like that. So a right is worth more than an obligation because you have, and here the terminology can be a bit cumbersome. So I will try not to use the word option when I'm not talking specifically about an option. So the right, you have the flexibility, the choice to do something, or the choice not to do something. So a right is worth more than an obligation. Well, if two people are going to exchange a contract, and the contract says that one party, the buyer, has the right, and the seller has the obligation, we've just determined that those are not equivalent in value. A right is worth more. So in order to entice the seller to take on an obligation, what do we have to do? Who would take on an obligation to come to class every single night that it was offered, every Wednesday night? Would you take on that obligation for free? Yeah, as Orlando.
No.
Right? Okay, so as Orlando put, the buyer would have to pay more. Brianna says, no, I wouldn't take it on for free. Okay, Brianna, what if I said, I will give you $500 if you come to class every Wednesday for 16 weeks?
Sure.
That is similar to an options contract. The seller is taking on an obligation. We will see what that is later on in class. Orlando?
Yeah, I pay for FAFSA and I'm obligated to come because if I fail the class, I have to pay.
There you go. That's a little bit different. That's not a, so this is what you have, you have financial aid and they say you are obligated to come to class, otherwise we will give you a financial penalty.
Next time I'd have to, if I fail the class,
Mhm.
then next time they won't give me financial aid. I'd have to pay out of pocket.
Okay, yeah, so there's a, financial penalty there if you do not fulfill your obligation. Okay, so this exchange of money that takes place to entice the seller to take on the obligation, we call the premium. The premium is an amount of money that changes hands at the start of the contract. Orlando is the buyer, he gets the right. Matthew is the seller, he gets the obligation. Well, the value of those two things are not equal. So to make it equal, Orlando says, hey, I'll give you some money right now as well. And Matthew goes, okay, I receive money and now I have the obligation to do something. This premium is paid in cash at the start.
So quick question, Professor, sorry. Just to get it straight. So the seller is receiving the premium?
Yes, seller
Okay.
demands the premium in
Okay.
order to entice them to take on the obligation.
Okay.
Options, again, we're going to ignore anything like transaction costs, etc. Options are a zero-sum game, meaning if one person wins, the other person loses an equal amount. The buyer at the start pays the premium. We can call it $1. The seller receives that premium, also $1. The buyer has the right to do something. And when I say here, but not the obligation, that means they have the choice. They can do it or not do it. The seller takes on that obligation. The buyer has a payoff, which we will call X. The seller has a payoff, which we will call negative X. What is X minus X? 0. There are 5 components to an option. There's the underlying security, the S&P index, Apple stocks, gold, unleaded gas. What, those of you who've traded options, what did you trade an option on? It's going to be an individual stock or a stock index, presumably. Okay, so Matthew did Facebook and S&P. Richard, do you remember which stock?
There were so many. It was probably like 10 years ago, but I did a lot of tech stock, I remember, and I did restaurant stocks. I remember Boston Market before it got sold. I remember I did them a lot.
Okay.
So, but those are 2 industries. So.
Kirk, what do you do? Individual stocks or indices? We'll wait for Kirk.
Is my audio working?
There we go. There we go.
Switch it up here a minute.
So that's the first thing. What are we going to trade an option on? And we'll talk about that in a second. We'll get something that everyone's familiar with. Last night, we used unleaded gasoline because that's something that everyone knows the price of. Most of the class had a view one way or the other, what they think is going to happen to the price. The other is the premium. Well, the premium is the amount of money that the buyer and seller agree on in order to exchange contracts. The strike price is the price at which something happens. The contract is predicated on a security potentially changing hands at a certain price. That price is called the strike price. The expiration date. Options have a finite expiration date. That again is determined between the parties. And then the option type, a call or a put. If you don't understand what all these mean right now, that's okay. We're going to go over it. So a call, we'll start with a call because that's the most intuitive, is the right to buy something. The seller has the obligation to sell. What do you guys think? Are you comfortable with unleaded gasoline as a product?
Yeah.
What's the ticker? Oh, the future.
On Bloomberg, it used to be HU. I don't know what it is now. So this is actually a futures contract. If you remember from class 2 weeks ago. So now Kirk actually just, he lives in Austin and my fiance and I were just there. Any idea how much a gallon of gas is in Austin right now? It's about what, $2.89, Kirk?
Oh, yeah, I think so, roughly.
California right now is about $5.50. We'll call it $5 just so that it's double the spot price. So if you look in the chat, I'm putting current prices. June, when is the prime season for gasoline?
Summer.
Yeah, summer driving season. So what we're going to do, if you look in the chat, the spot price is $2.50. California is $5. So we're going to assume that California is basically double whatever this is. Obviously, that's not always the case, but just for simplicity's sake. So June 2023 is $2.60. That's the New York one. And we'll say then California is $5.20. So this is June 2023 delivery. Put in the chat if you think, just put higher or lower. If you think in June of 2023, LA gasoline, Los Angeles unleaded gasoline is going to be higher or lower than $5.20. Wow, everyone's higher. Interesting. Okay. What would happen? Let's say you guys have some sort of company and you offer rides to people in the summer and you're going to need 1,000 gallons of gasoline in June. What kind of alternatives do you have? So you have a business. Oops. Your business will need 1,000 gallons of unleaded in June 2023. What are some things you can do? Okay, Kirk, you could buy a June 2023 future. So we'll say buy June 2023 future at, we'll say $5.20 a gallon. And then what happens if you do that? If you buy the June 2023 future at $5.20 a gallon, and in scenario A, gas is $7 a gallon, what happens? Are you happy or sad?
Happy?
Why?
Really happy
Why are you happy?
because you secured that lower price.
You locked in the price of $5.20. It's now $7. So you can still provide your service. You've saved yourself $1.80 if you had done nothing. B, gas equals $5.20 a gallon. Are you happy or sad that you bought a future?
Sad.
Why is that?
Well, it was what was the future buy-in? Was it 525?
It was $5.20 as well.
Oh, it was. Okay, then the same. Just I thought it was 525.
Yeah, it was $5.20, same price.
I mean, happy still because I mean you didn't lose any money.
Okay, you didn't lose any money. Now, what in scenario C, what if the price of gas goes down to $3 in June? Why are you sad, Orlando?
Because you overpaid for the gas?
You overpaid. If you had done nothing, you would have gotten it cheaper. Now, if we look, and this makes it a bit tricky with, so I'm going to do the best that I can here. You guys can see the whiteboard? So we're going to say right here is 520. If you buy a future, we will put the future in pink at 520. What does your P&L look like? Your profit and loss. If gas goes up $1, do you make money or lose money on your future? Exactly. You've made $1. If it goes up $2, so we can go over here and we can write profit, loss. And if it goes up $1, we make $1. If it goes up $2, we make $2. What if it goes down $1? We lose $1. If it goes down 2, we lose 2. Well, that looks like this. What is the slope of this line? We will say long underlier or long the future. The slope of that line equals 1. Also, if we do nothing, so Kirk said buy a future. If we don't buy a future, we could just wait and see what happens in June. And if it's gone up to $7, well, now we're overpaying relative to what we could have done. If it goes down, we've saved money. Is there another way? Well, you all think gasoline is going up. I'm going to take the other side of that trade since no one else thinks it's going down. So what we're going to do is look at this. So here's June 2023. We're going to look at options. And we are going to look at, now I've got to kind of estimate here because we're basically doubling the price. So 160. So let's say, what should we say? Well, let's do the at the money, which was what was the price? 260. And that is 38 cents. So what's that? 15%. So let's call it 50 cents. So we are going to say the June 2023 520 call costs 50 cents per gallon. What does that mean? Anyone want to take a stab at that? So what do we have here? What is the underlying security?
Unleaded gas.
Unleaded gasoline. What is the premium?
50 cents. 50 cents.
50 cents. What is the strike price?
Was it 260 something?
260 for the future, but we're doing California here.
Oh, yeah,
So we're just doubling it. So 520.
520, right?
What is the expiration?
June, was it?
June of 2023. And what is the option type? A call or a put?
It was a call, wasn't it? Yeah.
It was a call. Who wants to buy this from me for 50 cents? First person to put it in the chat gets it. Okay, Matthew. Matthew purchased the call for 50 cents. What does Matthew have now? He just gave, let's just think about, we're doing it on a single gallon of gas. So Matthew just gave me 50 cents. Is he the buyer or the seller?
He's a buyer.
He's the buyer. So what does the buyer have in this transaction? Do they have a right or an obligation?
He has an obligation to purchase if the strike price is reached in 2023, June.
Who received the money, Matthew or me?
You, the seller.
The seller. The seller has the obligation. The buyer has the right. So he now has the right. He paid money. I received money. I have an obligation. Are we clear on that before we move to the next step? Now, what does Matthew have the right to do?
To exercise his option.
Okay, which is what? In student-centered language, explain to me what right he has.
He could purchase the gasoline contracts at the strike price that
Exactly. And Kirk, it was, we doubled it because we're saying it's California. So we're just doubling the price. So he has the right. So we'll type here, buyer has the right, but not the obligation to buy one
What about
gallon
the
of
clutch on that?
gasoline from seller at 520
Mess
per
with it or
gallon
no?
before June 2023.
Okay. Okay.
What, before we get into graphing this, in what scenario would Matthew want to exercise the right to buy a gallon of gasoline from me at $5.20?
Well, definitely if the prices of the option goes above 520, because he'll be
If
making,
the option goes above 520,
um,
The market cost of the gas,
of, exactly, Juan, the market, what are we talking about here again?
the gas. What do you mean?
If a gallon of gas is more than 520,
Yeah.
he needs to buy 1 gallon. Is he gonna go to the local Chevron and pay $6.50 for that gallon?
No.
No, he's gonna say, hey, Eric, remember, we signed this contract, you have to sell me gas at 520. So if the market price is above 520, he's going to buy it from me instead of buying it in the market. If the market price is $3 a gallon, is he gonna go buy it from me for 520?
No.
No, he's gonna just buy it in the market because it's cheaper. So let's graph this and see how it looks. Now, for explanation purposes, I try to think of something physical, something tangible that we can think, oh, he's gonna go buy it in the market or he needs it or something. But many times with options, people are just speculating on the price and they don't actually have a use for 1,000 gallons of gasoline, or we're not end users of it, nor are we producers. But I think in many ways it helps to understand what would be the underlying transaction. So let's graph this a bit. So if the price of gasoline, so this first black line, let me change this here. And I'll say price of gallon of gasoline is here on the x-axis. And it was 520 when we struck the deal. What happens if the price goes down to $3? Does Matthew buy gasoline from me at 520? No, he doesn't. Does he make or lose any money? What does he do with that contract? It's now June 1st, 2023. Gas is at $3 a gallon. He and I have a contract where I'll sell him gasoline at 520. We've determined he doesn't want to buy it from me at much higher than the market price. That's right, Orlando. He does nothing with it. He can rip it up. He can mail it back to me with some nasty words. He can frame it, put it on his wall. Well, we're saying, Kirk, we're saying it's now the day of expiration. He has the right to buy gas from me at $5.20, and it's now $3. So it has zero value. So it expires worthless is the term. Does he have any P&L impact on that?
The loss of the premium he paid, the 50 cents.
He lost the premium, and the premium was 50 cents. So we will go here and we will put in negative 0.50. And so we will say at what, $3, which is here, his loss is 50 cents. We can do a bit better than that, can't we? What if gas goes to $2 a gallon? What does he do? Same thing. What's his P&L, Juan? Minus 50 cents. Okay. Gasoline goes to zero. They're literally giving it away. What's his P&L?
Same.
Well, it's the same. All he can lose is the premium that he paid. If gasoline literally goes to zero and they're giving the stuff away, come on by, fill your cars, we won't charge you anything. Okay, so we determined that there, the most he can lose is 50 cents. At $5, does he buy it from me for $5.20? No. At what point does he start changing his mind?
When your price is cheaper.
When my price is cheaper. Exactly. Well, what is the price at which he can buy it from me? What did we determine in the contract? $5.20. That's
$5.20.
right. So what we will do is we will draw a line here to $5.20. And then at $5.20, now what happens? Well, what happens for every penny gas increases? What happens? He makes a penny. If it's at $5.21, he can buy it from me for $5.20 and save himself a penny. Is he going to lose money? He'll still lose money, but now he's on the way to making some back. And now for every penny, 10 cents, dollar, whatever, that gasoline goes up, he now makes exactly that much. The slope of this blue line here is also the same as the pink line. What did Matthew do? Did he buy something or sell something? He bought a call option, which means he is long a call. Why did this blue line bend here?
The premium, right? Well, the premium you have to pay, so it's offset, right?
That's not why it bent at this point. What is this point? Right, Karen? That's when the price increased, but why? Why is this significant?
Is that the increase in the premium value?
No, the premium determines how far away this blue line is from zero. So if the premium isn't 50 cents, it's 80 cents. It just means that the blue line goes here. But then it will still bend at that same point. What is this point here that causes this blue line to bend?
Is it the time value? No.
There are 5 components. Willard, it's the strike price. When you graph an option, options only bend at strike prices. I'm going to put that in the chat. Options, when you're graphing an option payoff, it only bends at the strike price. If I were to draw a line, yep, that will 100% be on the test. That's why it's in bold with a bunch of asterisks. Options only bend at the strike price. I could give you a graph like this, and if I had it labeled properly, I could say, what is the strike price of this option? And if it were labeled clearly enough for you to read where that is on the x-axis, you would be expected to know that. If it said $8 here, and I drew a call option that went like that and then went up, I would expect you to say, oh, that is a call option with an $8 strike. Questions on the long call. What is the difference in these two payoffs? So Matthew thinks gasoline's going higher. He could buy gasoline, or he could buy a gasoline future, which would be this pink line, or he could buy a call option, which is the blue line. What is the difference between them?
Well, one's a commodity, one's an option or the derivative.
Well, technically a future is a derivative as well. But if you're buying the spot, that is correct. That's not a derivative. But we're thinking, again, what have we been talking about all semester? Risk reward. So what is the most Matthew can lose in the pink line? If he goes, you know what, tell it, I'm just going to buy the gasoline I need right now, or buy a future. What's the most he can lose?
The 50 cents, all right?
On the pink line?
Yeah, isn't that what he originally paid, was 50 cents for the gasoline? The premium?
Was there a premium paid on the pink? So the pink is the futures contract. You
Right.
bought it at 520.
520 strike price, but the premium he paid was,
No. A future is the same as if he just went to the store right now and bought all the gas he needed at 520.
also he just paid 520 for that future then,
Exactly.
in this case, okay. All right.
So then if in June they're giving gasoline away for free, well, he's lost $5.20 because the value of the gasoline he has now is worth $0. Is everyone clear on that? If you buy a share of Amazon at $100 a share, what's the most you can lose?
$100.
Yeah, it can go to $0 and you're out $100. The blue trade, where Matthew bought the call option, what is the most he can lose?
That'll be the 50 cents.
Yeah, 50 cents. If gasoline goes to $4, he loses 50 cents. If it goes to $3, 50 cents. If it goes to 0 and they're literally giving it away, he's only out 50 cents. What is the most he can make in the pink scenario?
More than 520.
Okay. So what? 570?
Anything that's above, you're not, as long, anything that's above the black line's profit.
Yeah, but I mean, how much profit can he make?
Unlimited.
Yeah, it's unlimited. What about in the blue scenario? Well, I guess it's also unlimited. It's like slightly less than infinity. Or it will take you longer to get to infinity than the pink line. Do you see the trade-off here? In what view are you trying to express in the pink and the blue scenarios? What do you think is going to happen?
Like the leverage.
How do you get to profit, Matthew? What has to happen for you to make a profit? Okay, be more specific. What kind of a change in price? It goes down, goes up, spins in circles. Nothing happens. Vertical, it goes up here. What are we taking bets on or gambling on or expressing a view on? Yes, Orlando, an increase in price. You expect the price of gasoline to go up. And so you will either buy the underlier or you will buy a call option. In both of those scenarios, you will profit. The big difference is the blue one has an expiration, June of 2023. The pink one doesn't. So you give up some time, and in exchange, you don't have downside. And for that, you pay a bit of money. So you can see here, what is this pink, where the pink and the black cross, that is 520. That is the current market price. This is also where the option bends. What is that? What do we call that? We call that the strike price, which is abbreviated as K. What about, can we move that? Can we move these things? Guess not. What about this line or this point here? What is that? That is the break-even price. How do we calculate the break-even price? Well, what do you think the break-even price is here? So this bends at 520. And how much money do you have to earn back before you start making a profit?
50 cents.
Why 50 cents, Juan?
Well, that's the money you put in. So in order to have a profit, you have to be above that.
Exactly. Your break-even price is K, the strike price, plus P, the premium. Questions on this?
Can you explain strike price again real quick? I didn't catch it when you first mentioned it.
Strike price is the price our contract stipulates. Who bought this for me? Oh, Matthew. Matthew has the right to purchase a gallon of gasoline from me at $5.20. That is a price that he and I agreed on. We could have agreed on $5.30, $5, $6, $100 a gallon. We could have agreed on any strike price. But given what we set up and looked at, June 23, $5.20 strike price. Based on that, we estimated the premium to be 50 cents. If we change the strike price or the time to expiration or anything like that, that will change the premium. Certain options are more valuable, others are less valuable. We'll go over that later on after the break. What other questions do you have on this blue? Is everyone clear on Matthew's payoff? This is the payoff on the date of expiration. And if gasoline is at $4.50 a gallon, what is Matthew going to do? On expiration day? Exactly, Orlando. He does nothing. And the option expires worthless and he loses 50 cents.
He can try to sell it though, as he sees the price go down.
We're talking about it is 10 seconds before expiration. So a decision has to be made in the next 10 seconds and a
Okay.
gallon of gasoline is $4. Is he going to buy it from me for $5.20?
Well, he already possesses it. That's what I'm saying as a buyer.
Again, this is, and sorry, this is my apologies. Ignore any offsetting positions that he
Okay,
might have. Right now, we're just looking at the blue line. Matthew bought a call option from me because for whatever reason, he wanted to profit if the price of gasoline went up. Maybe he's an end user of gasoline and he wants to lock in a price. Maybe he's just like, hey, you know what? I think gas is going up and I want to make money off that. There are myriad reasons why people are active in the options markets. So we don't necessarily know all of the underlying reasons, but we know how they will behave. If Matthew has a $5.20 call that's about to expire and gas is $4 a gallon, he's not going to buy it from me at $1.20 above the market price.
I have a question.
Please.
So if I were to buy gas options and they do go higher, how do I sell them? Do I just sell them to somebody else in the market or?
Exactly. Yeah, exactly. You got to remember the bulk of the people participating in these markets aren't end users or producers. And so if gas goes up to $7 a gallon, you would just sell the option. And it would be worth, you know, $1.80 more or less. Because the odds are somebody on the other side wants to close out their option position too. And they don't want to have to deliver gasoline. So you remember I told you about I bought a silver future? I actually took delivery of it. Most people, the vast majority of people do not. They don't take delivery, nor do they intend to deliver. They're just speculating on the price of gold and silver. But with most of these futures markets, you can actually take delivery and deliver. And that's what keeps them in line with the underlying market. Otherwise, you can get this thing called the basis, where a derivative price moves and is miles away from the underlying price. So that is one of the benefits of deliverable futures and options. Is that ultimately, if the price is very, very far away, people just be like, and my buddy, he hasn't gotten back to me, but the guy I told you, Boris, who trades soybeans and corn and stuff, he often takes delivery on things when there's a big kind of spread between the front month and the back month. I don't think he does options very much, but someone like him keeps prices in line throughout the time curve. Good question. Any other questions before we go on to the other side?
So if you would want a delivery, would you like request that when you pay your premium? When is that?
No.
Oh.
No, that's all done. If anyone cares, so this is the unleaded gasoline. So basically, there used to be a bunch of different futures exchanges, and they've all kind of merged. So what we will do is go to, let's look at futures specs. So the contract is 42,000 gallons of gasoline, Matthew. So I hope you've got some room in your garage for that. Settlement method deliverable. So this means you can actually take delivery of it. Procedures, minimum threshold. Settlement procedures. Let's see. And there are very specific things. Daily settlement, active month. Settlement procedures. So the mini ones are not deliverable. So there are mini contracts in a lot of these, and they just settle at a cash value. So you would never risk getting delivered if you trade the mini ones. Okay, here we go. New York Harbor unleaded SD futures are physically delivered upon expiration. Let's look at the rule book. And this will tell you the okay, so the specifications. F grade reformulated regular gasoline for blending with 10% denatured fuel, ethanol 92% purity. So anyone who's a petroleum engineer or anything like that will probably understand what this means. Defined in ASTM is being properly designated for sale in New York and New Jersey in accordance with the EPA. So it's basically, it looks like it's gasoline that can be legally sold in New York and New Jersey. Remember, different states have just different rules. That's one of the reasons that California gas is so expensive, because we have special blends. And then these are different ways to describe the purity or level or whatever of the gasoline. And then there should be, the oxygenation, corrosion, this is all stuff for the engineers. And shall comply with EPA requirements. So presumably, Matthew, you can't just go and load them in those, those 5-gallon barrels that you get at Walmart to put water in. So apparently you can't just have 42,000 gallons worth of those. Training specification, and there should be where it can be delivered. Okay, the seller, so that's me. The seller shall have a quantity and quality of product in tank at one or more eligible delivery facilities in accordance with the requirements. So basically, these futures contracts, usually what they do is they say, these are acceptable delivery points. And I don't know what it is. Boris trades soybeans and corn, and it's going to be like grain elevators. I'm guessing there are 5 or 10 or more of them in the US, probably in the Midwest. And you can deliver to any of those points as long as it meets all of these specifications up here. But you can't say, oh, hey, I've got your gasoline in Hawaii, come pick it up. Because that would not be one of the eligible delivery facilities. And for the silver that I took delivery of, there are basically 5 vaults in the New York area. I think 4 in New York and 1 in like DC or Delaware or something like that. And then this is the procedure. You don't have to worry about this. It's all pretty, even I was confused with all that stuff. And then here you go. Okay, so it's got to be FOB X shore facility with all duties paid. Da, 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 da. So this is all like, you know, the specifics that people like us aren't really going to care about too much. Usually if you get delivered on something like this, they'll give you they'll say, okay, you've been delivered, you have a receipt. If you don't want to actually take delivery, we can sell that receipt, because there are people who use this stuff. And so I took delivery of cattle one time by accident, and they basically gave me a receipt, and then I had to sell it. It cost me like $300. I should have kept the actual receipt and framed it. That would have been pretty cool, actually. Any other questions on that? Thomas, I use Interactive Brokers. That's more for professionals. Most of the professionals I know use Interactive Brokers. But that's not the only one. But they don't allow you to take delivery. So I use, if anyone's heard of Archer Daniels Midland, ADM, they have a futures arm. I use them as well because I can take delivery at ADM. Any other questions before we get to what's more important than Matthew, i.e. me? Questions on Matthew's payoff? This blue line. No. Okay, now I need some help from you guys. What happens if gasoline goes to 0? Now, what have I done? What is my side of the trade? Matthew gave me money and he has the right to do something. That's right. Excuse me, Orlando, I'm the seller. So I received cash up front. And what do I have? What is my side of the contract? I have the obligation to sell. To sell what, Juan? A gallon of gasoline at $5.20. So what do I want to happen? Well, Tyson, if it goes up, the price of gasoline, Matthew's making money.
You want it to go down so you can get it cheaper than 520.
Okay, so if gasoline goes to 0 and they're giving it away for free, how much do I make money or lose money?
You're making money.
Okay, I'm making money. How much do I make if it goes to 0? Well, let's walk through the transaction. What happened at the start when we signed the contract? That's right, Karen. I collected 50 cents. It goes to 0. Matthew tears up the contract. What money changes hands now at the end of the contract? Does money change hands at the end of the contract? No, Richard, exactly. So if he loses 50 cents when it goes to zero, how much do I make? All right, Richard says 50, Orlando says 520. Does Kirk know about the student Thunderdome? No. Kirk, you ever seen Mad Max Beyond Thunderdome?
I don't think so.
Next time I come visit, that's what we're gonna do. We're gonna
All
watch
right.
Mad Max.
Let's do it.
The one with Tina Turner. Never seen that?
No. No, man.
I don't know how.
Mel Gibson.
Yeah, exactly. Basically, it's a death match. And the motto is 2 men enter, 1 man leaves. So when we have students who disagree, we have the student Thunderdome. 2 students enter, 1 student leaves. So we've got Richard and Orlando. Gasoline goes to 0. Matthew has a contract that he paid 50 cents for. He tears it up, throws it in the trash. He's only out 50 cents. How much money did I make? Well, all I did was collect the premium at the start of the transaction. There's no more money that changes hands. So I make 50 cents. If gas is at $1, how much do I make? 50 cents. $2, 50 cents. $3, 50 cents. At all these points, Matthew just tears up his contract. Is it a straight line across forever for infinity?
Yes.
Yeah, just like that? All the way out?
Oh, well, not that far.
Oh, how far? Well, that's infinity. How far out does it go?
Expiration?
There's no time on this graph. Bisect to form an obtuse angle. I have no idea what that means. I'm gonna have to look that up. Well, does this line bend at all?
No.
No.
Interesting. Matthew bought the 520 call, and when we graphed P&L, where did it bend?
Strike price?
Higher price, yeah,
What is the strike price?
520.
Well, let's think about this. Let me draw it a bit better, sorry. Let's draw it kind of here. That looks more equidistant, doesn't it? At 520, I've made 50 cents. Matthew can tear his contract up. He can buy it in the market. Doesn't matter. At $5.30, what does Matthew do? He can buy the gas in the market at 5.30, or he can buy it from me at 5.20. What's he going to do?
Add for 520 and save himself 10 cents.
Exactly. He's going to buy it from me at 5.20. So I make 10 cents less. So what happens is, as the price of gas goes up, I now start losing money.
You start losing money on your premium, but not on the contract price. Just like you said, if it goes to 5.30, you're gaining 10 cents off the contract price.
Who's me?
You're the seller.
I gained 10 cents. I just sold something that cost $5.30. I just sold it for
Oh.
$5.20.
Right. I'm thinking of actual contracts, how they work, and you're really oversimplifying this to the point where it's mind boggling.
I'm sorry.
No, it's
You
okay.
got to remember, this is, and not to give excuses for why I'm a lousy professor, but this is one of the challenges of teaching in this format is, I'll have students who've been trading options for 6 to 12 months, and then I'll have students who've never even heard of an option. And so it's like, at what point, because last night's class, there were 4 students in there who were just totally all over options. And then there were 4 students who were kind of like, not really grasping this. So I figure let's try and start from the very bottom and then see if we can work our way up.
Right, because in actual contract option world, if it goes up to 530, the strike, if the price goes to strike, then you made it, if the premium's gonna go up because.
No. The premium changed hands at the start of the contract. Now the contract expires in 5 seconds. And Matthew, who has the right, has to make a decision. Do I buy gas from Eric at 5.20 or do I not?
Right, okay, yeah.
And if the market price is below the strike price, he won't buy gas from me at 5.20 because he can get it cheaper elsewhere. If the market price is above 5.20, he will buy it from me.
Right,
If the
okay.
market price, we determined the break-even price for Matthew is K plus P. The strike price, 5.20, plus the premium, 50 cents. So at 5.70, Matthew goes, hey, I can buy gas from Eric 50 cents cheaper than in the market. But I paid him 50 cents for that right. So net, he's broken even. Well, for me, I say, oh, I collected 50 cents from Matthew up front, but now I have to sell him gas 50 cents cheaper than the market price. So I lost 50 cents on selling the gas and I collected 50 cents up front. So it's a break even. If you add the red line, my payoff, which we will call, damn, it's so confusing. What will we term this red line? Matthew is long a call because he purchased a call option. What did I do?
You sold.
What did I sell?
You short the option, you sold the gasoline option call.
Short a call. So the long call payoff plus the short call payoff will always equal 0. If I make 50 cents, he loses 50 cents. I make 50, he loses 50. I make 50, he loses 50. I make 0, he makes 0. He makes 50, I lose 50. He makes $3, I lose $3. He makes $200, I lose $200. What is his max gain?
Well, it could be unlimited because the price could go sky high.
Exactly. His max gain is infinite. What is the most he can lose? Not in dollar terms, but what do we call that?
Premium.
The premium. In the chat, if you are long a call, you have potentially unlimited or infinite gain, and the most you can lose is your premium. If you are short a call, what is your max gain? Well, look at this red line. Where's the highest point on the red line?
$0.50.
50 cents. What do we call that?
Premium?
The premium. What is the most I can lose for selling the call?
The premium?
Well, where does my red line? You guys can see my cursor here, right?
Well,
Oh,
520, right? Well, 570 technically.
No. What happens if gas goes to $10? How much do I lose? I've agreed to sell it to him for 520 and it's now $10 a gallon.
The difference.
Oh, you know what? What if it
Or-
goes to $20 a gallon?
Or
What if it goes to $50 a gallon?
Is it an infinite loss?
Exactly. As Kirk put, it's unlimited. The short call, the most you can ever make is the premium. The most you can lose is, in theory, infinite. $50
So
a
the-
gallon. Yeah, riding your bicycle. Exactly. Questions on this?
so in a short call, that's a covered call position.
No. This is what we would call a naked call.
Well-
Meaning you only have this position.
So it's an uncovered or naked. Okay.
Exactly.
So you don't own the asset. That's it.
Correct.
Right. See, that's something else I didn't get in this. That's why it's infinite. But if you did own the asset, the most you can lose is that. And that's why I said the 520.
In theory, but what is your opportunity cost? If you had a gallon of gasoline in your garage and you sold this call option, and then that gallon of gasoline is now worth $1,000 and you sold it for 520 plus the 50 cents, okay, you didn't lose 9,000.
Right.
What did I say it went to? No, $1,000. You didn't lose 900 and something dollars, but you missed out on making 900 and something dollars. So it's the same thing.
Okay. I'll have to, I think, I never did uncover or naked calls. So I always did cover. I didn't do cover calls. I sold or bought.
Well, this is why if you're new to options, they won't let you sell options. Because this is the most you'll ever make. And you can easily lose a lot more. What is natural gas? Anyone know? Yeah, stuff that you use for your stove in your house, etc. Anyone heard of option sellers? So these guys, this was 2018. And these guys would sell call options and put options. And yeah, there you go. In case it's not obvious, this is what happened to them in 2018. So here was natural gas prices. Sorry, my computer's just like going. So here's a 10-year chart of natural gas. And basically it's here 2016, and these guys are selling like $4 calls on natural gas and $2 puts just all day, every day. And it never gets there, and then something happens. I can't remember what, maybe it'll say in the article, but natural gas goes from October 15th, 289 to a month later, it goes to $4 almost in a month. A huge move. So what happens? Well, obviously that. So let's read. They were a Tampa CTA, Commodity Trading Advisor. So we would give them our money and then they would trade it for us, selling options. The company was called optionsellers.com. The minimum investment was 250,000. So this person who wrote the article estimates they had 150 million bucks that they were managing. Who knows exactly? On November 15th, 2018, will you remember that was, well, right about here. So on November 15th, they told their investors, not only have we lost all your money, but you owe more money. So, oh, hey, Richard, you gave them 500,000 bucks. That's gone. And you're going to have to write a check for another 250. Then this was the CEO who posted an apology on YouTube. I don't think the video's up anymore. Maybe it is. No. What's his name? James Cordier. Apology. That's still up. Yeah, you can, I'll pop that in there. You can, do you guys want to listen to this or no? It's 10 minutes. We don't have time to listen to all that.
Yeah.
Sorry?
Yes.
I'll pop it in here. I've never listened to it, but there it is. There's got to be a synopsis. We'll watch it later on. Oh yeah, people did all kinds of fun things like that. But this is why if you open an account and you're new to investing and trading, they won't let you sell options because your risk is much, much higher. If you buy options, if you have $250 in your account and you buy $250 worth of options, well, if it goes to zero, you have nothing in your account, no big deal. But the broker never wants to be in a situation where you've lost more money than you have, and now they have to come after you and get the money so that they personally are not out of pocket. What are my thoughts about the FTX collapse? Great question. So any more questions on call options? We probably should have started the class with FTX, but given we had a few people short of a quorum, maybe it's better now. Further questions? Do you want me to save this and pop this in the?
Yeah, the only reason why I brought up because I, kind of similarities between that, what you just presented. So that's why I thought it may be, a segue to this topic. But if not, that's cool. So.
No. I look, this is very apropos of. So there's that call option payoff. And can I pop this in the chat? Yeah. Am I able to put this in the chat? Let's see.
I took a picture.
Of me? Oh, that's very sweet of you.
Oh, of the graph.
That's great. That's wow. I'm touched. Oh, of the graph. Oh. Okay, there we go. That's in the chat. So the call option payoff is there. So you can look at that. Now, FTX. All right. Who wants to give us a quick and dirty on what happened with FTX? What is FTX? What was FTX?
Bankrupt, Chapter 11.
Okay, well, yeah. But what did they do? What was their business?
Exchange for crypto, the exchange market for cryptocurrency.
Exactly. So built by traders for everyone. So I believe it's similar to Coinbase, correct? Where you can open an account, you can put money in, and then you can buy and sell crypto and Tether, and they have their own coin, FTT. Oh wait, sorry, you guys aren't. Am I screen sharing this or no? No. There we go. So it's a crypto exchange. There's that. There's Coinbase. There is what is it? Binance or Binance? I don't know how you say it. What were they doing? What did we talk about the last 2 weeks with bonds?
Duration,
Uh-huh. What were we talking about with duration?
like lack of liquidity because the investment is too far out.
Exactly. Exactly. Now let's see if this is the one that was being shown around. Yeah, that's the one. Let's see if we can get a better photo of it. So there were some things going around that showed their balance sheet. Let's see. Here we go. I think that's probably a better one. This is probably as good as we're gonna. That's Alameda. So they had a, I don't know if they owned 100% of it or what, but they had a related company that, so this is actually a number of different things. So let's look at this one. Open image in your tab. Here we go. Okay, so liquid assets. So they had 9 billion in liabilities, and they had a little over that in assets. Now their liquid assets, less than $1 billion. Okay, well, I mean, that's like a bank, right? A bank isn't going to have 9 billion in liabilities and 9 billion in cash sitting around. But when you look at this, and I've become friends with one girl on Instagram who works for one of these crypto companies, and I was asking her about this. I don't know if this is real in terms of what they actually thought their balance sheet looked like, but less liquid. This is SRM. Now, this is a coin. And if you go to Coin Market Cap, I'd never heard of this coin. It's called Serum. But if you go to Coin Market Cap, you can look. Now, bear in mind, there are almost 22,000 cryptocurrencies in existence, worth 830 billion. At the peak a year ago, this market, the whole crypto market, was worth almost 3 trillion. So let's look at, where's the search? Okay, so we're going to type in Serum. What? There we go. So this is the coin that they claim they had $2.2 billion worth. Now you go to these and you go to the cryptos and you can go by market cap. And this is, I don't know if this is, so according to this, there was never more than $1.2 billion worth of Serum in existence. At its peak, it was the whole Serum coin ecosystem or market cap or whatever you want to call it was worth just over $1 billion. And according to this, they had 2.2 billion worth of it. I don't know. I don't know if this is true or not. I don't know if this is actually their balance sheet. This is what people have been sending around and posting on social media. But according to this, I mean, well, right there, even if they had all of it, it's worth, you know, here we're not even $500 million. So if they had all of it, they're off by a factor of $1.5 billion. More likely, this is probably only worth a few hundred million at best. I don't know how much Serum they had. APT. First of all, anyone have questions on that? So this is, they claim they had 5.5 billion of less liquid assets. Well, it looks like this might be 2 billion overstated, which means they don't have 9.5 billion of assets. They're down right away to 7.5 or 8.
I mean, they were repeating the books.
I'm sorry.
Were they saying what they didn't have?
I mean, it certainly seems like it. Again, I don't know if this is accurate, but just looking at the few pieces of data I have, and I'm not at all an expert in this stuff, how can you have $2.2 billion worth of something of which there are only $200 million worth in existence? If you own all the shares of Amazon, it's not going to be worth 10 times what Amazon is worth. So I don't know, that jumped out at me. And then you have these other ones, APT, MAPS. I think it's same kind of thing. We'll look at APT.
Do you think they treated that, the asset or that number as a derivative from?
So what they were doing is they had this related hedge fund called Alameda. So here, let's look at this. So, okay, so APT at the time was worth, call it $1 billion, and they had 600 million. I mean, I guess in theory, they could have had this much, but then they would have had the whole thing almost. You know, if you have $1 billion, if you have $600 million of a cryptocurrency that's worth $1 billion, what happens when you go to sell it?
Price drops.
Yeah. If you own 2/3 of something and you start selling it, there aren't going to be that many other buyers, and the price is going to go like this. Right there, the market cap of that coin dropped in half from November 6th to 9th. In 3 days, the market cap of it dropped in half. Then they had their own coin, which wasn't even listed here, but I thought it was listed as some of the assets. Oh, I'm sorry. That's MAPS. They had 300 billion of this APT. So you've got 1/3 of everything in existence. So yeah, you would expect the value of it to drop in half. So, okay, we've got $300 million worth of this. We start selling it. Now the value of it is cut in half. And you probably haven't sold all that much. That's my guess. Then what they were doing, I guess, is they were an exchange, so they were getting all these orders from customers. And then what they were doing is using that information, they being Alameda, the associated company. Alameda was using that information to trade ahead of customers, basically front running. That's illegal in the securities world. Is that really? His girlfriend, is she 28? She looks like she's 12.
Ex-girlfriend.
I was trying not to laugh.
She still looks like she's 12, but whatever. Anyway, so yeah, so they were doing that. They were front running customers. And then I think what happened as things started to unravel, they started taking customer money and lending it to the hedge fund. And that in securities, there's somebody else who did this. He was the former governor of New Jersey. He was a US senator, and I think he was the head of Goldman Sachs. It doesn't say. Oh, he went to University of Chicago. Oh man, they should take his degree away. This guy was a thief. And he did that. He was head of a company called Man Financial. He's ex-Goldman Sachs, but he was head of a company called Man Financial. And they were a brokerage that made their money from collecting commissions facilitating customer trades. And he's like, you know what? We're not making enough money. We need to take more risk. And so they started taking bets on European government bonds. It went against them. And then they took customer money to help them cover the margin calls for their losses. That is totally illegal. The guy should have died in jail. And it's unreal that, because he was the head of Man Financial. When did they do that? 17. When did Man Financial blow up? Man Financial collapse. When did it fail? 2011. And it looks like, and he ran for governor after that. That's unreal. So, you know, that's what you have is something called customer segregated funds. The idea is that this is customer money. It belongs to customers. A bank, an investment company, whatever, is not supposed to use those funds for its own trading, gambling, whatever. All right, let me go back and see the comments. Front money. So that's kind of the quick and dirty on what's come out so far with FTX. But if we look at the US Treasury yield curve today, well, let's look at it in 2021. Here we go. Here's the yield curve in 2020 and 2021. So what does this tell us? We spent 2 weeks studying bonds. We looked at yield curves. Somebody interpret this for us. And yes, Kirk, they can have it in treasuries. They can have it in some sort of money market funds. Usually they'll give you an option how you want it be held. So what is the black? The black is the yield curve at this point in time, March of 2020. You can see you're getting less than 0.5% all the way out to 5 years. A 30-year bond had a yield of 1.4% 2 years ago. This is right after COVID. Then, year and a half ago, look at this. Flat, 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 almost zero, all the way out to 3 years, and then steepens a little bit. During this period of time in red, you could invest money in FTX. Anyone heard of yield farming?
Yep.
Staking, all of these things. Investing cryptocurrencies for additional returns. Yield farms are decentralized finance investment tools, smart contracts. Yield farms may provide high interest rates, including more than 100%. Okay, so if I give money to the US government for 3 years, I get 0.25%. If I yield farm, I get 100%. Does that sound too good to be true?
Yes.
Right? Almost certainly. And look, I've got a buddy who made more money in crypto last year than he did at his job. And his job, he makes a lot of money. But he goes, look, I got, you know, it's termed rug, where basically people just take off with your money. So, okay, there's high risk, there's high reward. If you're okay with that and willing to take that risk, that's fine. But to me, this all seems like a bit of a Ponzi scheme. Instead, you should be looking at this. How much a farmer earns from 1 acre. That's a different kind of yield farm. Right? This is pure speculation. If you want to devote a little bit of your investments to pure speculation, go nuts. I bought Russian stocks after the invasion of the Ukraine.
I did too, unfortunately.
How
What'd
did
you
that
buy?
go?
Gazprom,
Yeah. Did you buy the ADRs in the US or the GDRs in London?
I think it was the London one.
Okay. Yeah, I bought Gazprom, I bought Norilsk Nickel. Basically, I put 1% of my net worth into Russian stocks. And I go, if it goes right, it'll be worth 5x, maybe 10x. If it goes wrong, well, it goes to 0. So we still have those securities, they're marked at 0. I bought Sberbank, which is like their equivalent of, JP Morgan, or probably Wells Fargo, but that one was sanctioned, so they allowed me to convert it to the Moscow line. So now I hold a Moscow listed stock, but foreigners aren't allowed to trade it. So we have, those of us who have Russian stocks, we have these US ADRs that aren't trading. And then I have a Moscow regular stock that I can't trade either. Who knows? Maybe it goes to 0, maybe it doesn't. But I'm certainly not going to put 25% of everything I own in it. So who knows? That's, if you want to devote a small percentage of your net worth or your account or whatever to speculation and, taking bets like that, that's fine. And I'm not saying don't do yield farming. It might work for you, it might not, but just understand that if someone's out here going, oh yeah, you can get 100% annual return, and this is the equivalent treasury rate, well, you hopefully, by taking this class this many weeks, you understand I must be taking on an absolute ton of risk. Maybe it's legit, maybe it's a Ponzi scheme. Either way, you have to understand that you're taking on a ton of risk. To me, this whole crypto market, it's kind of interesting. I've been teaching this class for 6 years, and it's interesting how you can just see how crypto is doing based on how many questions I get throughout the semester. Is there a need for 22,000 different cryptocurrencies? I don't see the need for it. Is there a reason that the entire crypto market cap was $3 trillion, which was 15% of US GDP? Almost. Again, what's the utility that most of these coins provide? FTT. Here's FTT, the value of it. Date. So it was worth 40, now it's worth $1.26. Yeah, I agree with you, Human. There's so we can go and make up a cryptocurrency and call it business 46 coin. And you use those coins to, I don't know, buy a better grade or who knows what. I have no idea. But I don't know the utility of most of these. Just Venmo me cash if you want to do that. Any other questions on FTX? Look, this coin was worth allegedly almost $10 billion at one point. Now it's worth 900 million. Amazing. Amazing. Crypto derivative trading platforms. Centralized collateral. I mean, what most of this stuff is, I'm going to do a meme on this. No. Oh no, this is what I want. There's no this meme. That's the one with the prostitute with the car. Man. That one. I do mean with that. Can you explain counterparty risk? What is counterparty risk? The other party may not fulfill their part of the deal. Matthew buys this call option from me. Gasoline goes to $20 a gallon. What's the contract size? Anyone remember? 42,000 gallons per contract. Let's say gasoline goes to $10 a gallon. How much would Matthew expect to make? Well, what's his profit per gallon? $10 minus $5.20, which is what? The strike price, minus 50 cents, which is the premium. And that gives us what? $4.30 profit per gallon. What's 430? That was 42,000. 165,000 or something. 4.3 times 42,000. $180,000.
That's pretty good.
That's Matthew knocking on my door tomorrow. Am I going to be home? Nope. I'll be in Austin at Kirk's house, hiding out. Say, Kirk, if someone knocks at the door, don't open it. That is counterparty risk. I take off. Matthew's like, hey, you owe me 180,000 bucks. I'm like, sorry, I can't pay. I'm bankrupt. That is counterparty risk. This is what you guys remember The Big Short? You watch The Big Short. The two young guys who were friends with Brad Pitt. They placed bets that had a massive, massive payoff. Did they have a problem? Richard, what was their problem?
Well, the rating companies weren't properly reflecting the assets, so they kept going up, and I don't know if they were losing premium, but
No, that's the you're thinking of Michael Burry, the Christian Bale's character.
right.
Two
No, but
young guys, remember they were in England and they had to have Brad Pitt help them out?
yeah, right.
And why did Brad Pitt have to help them out?
To sell their share,
Their contract.
their
Why
contracts,
couldn't they
right? Their
sell-
swaps, right? Or was it?
Why? Yes, exactly. Why couldn't they sell them easily? Who was the
Well,
other
again-
side of the trade?
Well, the market wasn't properly reflecting. They kept calling them crooks, the rating agencies.
No,
Because
it's
they-
not that. They had something called an ISDA, which is an agreement. It's part of the International Swaps and Derivatives Association, I believe. They had an ISDA that enabled them to trade OTC derivatives, over-the-counter derivatives, directly with a bank. Which bank did they have an account with that they made their big trade? Anyone remember?
Was it Morgan Stanley? I know there was that firm within Morgan Stanley that where the kind of the main characters are.
Yeah, that was Steve Carell's group.
Right.
This is the two young guys. I don't remember who they were, but they had basically, these two young guys placed a bet. Their bet was a huge winner, but who was supposed to pay them? Bear Stearns.
Yeah,
Exactly,
okay.
Kirk.
Yes, sure, sure.
They go, oh, Bear Stearns owes us 25 million bucks. How would you feel if Bear Stearns owed you $25 million? and Bear Stearns is about to go bankrupt, would you feel comfortable that you're going to get your money? Absolutely not. And that's why these guys were panicking. They're like, we made this huge winner trade. We might not be able to get paid on it because Bear Stearns is going to go bust. That is counterparty risk. Bear Stearns may not fulfill its part of the deal. My ex-girlfriend worked for Deutsche Bank. She worked for Ryan Gosling's group. At that time, they were told, we cannot trade any contracts that are involved with Bear Stearns because we don't know if they will be able to pay any money that they owe. Well, that means if you have something that says, oh, Bear owes me $10 million, and I say, hey, Richard, can you give me $9.5 million for this? Richard's gonna be like, nah, don't think so. Don't think so. How would you feel if you had a contract that you owed Bear Stearns $10 million? I'd feel pretty good about that. I'm like, I'm gonna go through bankruptcy. It's gonna be ages before I have to pay that, if ever. Well, maybe there's a chance they don't even find it. That is counterparty risk. Everyone talks about DeFi. What is DeFi?
Centralized finance,
Say that again.
decentralized finance.
Exactly. Now, can I open up a new one of these? Can I clear this? Yeah, I'll clear this. All right. The whiteboard. Is that okay? So what is decentralized finance, Human?
Well, in theory, it's supposed to be no sort of centralized organization that regulates you, which is why I'm kind of scratching my head as to why we're all asking, or they're all asking for regulation in the crypto space at the moment.
So can we use The Big Short as an example? Everyone okay with that? Yes, no? Fair. You guys read this? Lehman. Goldman. Deutsche Bank. Credit Suisse, my old employer. Who else we have? I don't know. AIG. Ford Motor Credit. Decentralized finance is, or was, probably still is, the CDS market, credit default swaps, which are insurance on somebody not being able to pay their bonds. So if someone doesn't pay, Ford Motor Credit owes Goldman. Goldman has a contract that they have to pay AIG. They have another contract with AIG. They have one with them. They have, Deutsche Bank would pay AIG. AIG would pay Credit Suisse. They might have more back at them. This is what DeFi looks like in the CDS market. AIG says, oh, I have a contract with Goldman Sachs. I want to offset it with Deutsche Bank. Do they just cancel it? No, they create a new contract. And then Deutsche says, hey, we want to offset that. And they create another contract. Goldman is owed money by these people and these people and these people. They owe money maybe to some of the same people and to other people. Questions on this before we take the next step?
I was curious as to how that would differ from traditional centralized finance.
We will show that next.
Okay.
Now, AIG is going bankrupt. Now what happens?
They all get impacted.
Yeah.
slowly.
Credit Suisse was owed money by them. They're not going to get it. Deutsche Bank was owed money by them and owed money to them. Goldman owed money to them. You know, is this going to impact Bear Stearns? Well, almost certainly they would have had derivatives directly facing them, but they may have had offsetting derivatives. Now what happens when now Bear goes under? And this becomes an absolute mess. And what actually happened was that AIG owed Goldman something like $13 billion and AIG was going to go bankrupt. So the US government stepped in and said, hey, you know what, Goldman, we're the government, you're Goldman, we're basically one and the same. Our guys go from your executive offices to ours and work in the government, and then they go back to Goldman, and then they go back and go. So we're just going to step in and we're going to give AIG $13 billion to pay you. Now, do you think any of you, if a bankrupt person owed you money, would the government step in and pay off the money that you were owed in full?
No.
Absolutely not, right? This was like crime on a colossal scale. And they should have let AIG go bust, and then Goldman may have gone bust. What a great world that would be, right? Goldman Sachs went bust, but we're not there yet. So it goes. So this is DeFi. There is a ton of counterparty risk in this DeFi system. And this is what we're seeing with crypto. And people think, oh, well, I want to transact directly with Human and no one else involved. Okay. Human and I can do that, but do we know each other? Assume we're just people who met out in the ether.
Nope.
On a crypto exchange, we don't know each other. Is there any sort of trust that he has for me or vice versa?
Not like that.
No, and this is, you know, this is what makes these systems so difficult. Maybe we can, okay, we don't have to involve anyone else and no one has to know what we do. Okay, there are advantages to that. But how do you ensure the integrity of the system and the contractual obligations? That is very difficult to do. Can I clear this? Now we are going to talk about a centralized system. Who was the buyer of the call option in the example we gave?
Wasn't it Matthew?
It was Matthew. Who was the seller?
You. You were.
Mhm.
Right.
This is how the futures and options on futures markets work. Eric? Matthew. We do not deal directly. Eric goes through Interactive Brokers. Matthew, whom do you use? Robinhood? This is the Chicago Mercantile Exchange. Matthew, oops, we don't want that. See that? Matthew buys. Matthew places a buy order at Robinhood, which goes to the exchange. Eric places a sell order, goes to the exchange. They are matched, those orders. The exchange is the buyer to every seller. It is the seller to every buyer. The money, Matthew pays the premium. We'll put that in green since it's money. The money goes here, it goes here, it goes there, and it goes there. I receive it. He pays it, it cycles through there. Now, he has the right, he has paid the money, I have received the money, I have given him the right, I now have the obligation. What happens if Matthew goes bankrupt? Am I out of luck?
No, you're good.
Why is that, Thomas?
I guess united you stand and divided you fall. Rationalized the what you call it, the liabilities. So
I never had a contract with Matthew. I had a contract with the exchange. Matthew had an offsetting contract with the exchange. The fact that he went bankrupt is not my problem. It's the exchange's problem. It's Robinhood's problem.
And can't the,
Go ahead.
I'm sorry, I was gonna say, Professor, can't the exchange also mitigate its risk by purchasing insurance for that kind of event?
Well, what they do is they charge the broker's margin. So if he wants to, he's buying an option. So that the most he can lose is 50 cents. But what happens for me, as the price of unleaded gasoline goes up, my losses go up, and the exchange will say to IB, hey, you deposited $2,000 for this, and now the loss is approaching that. You have to deposit more money. IB will turn to me and say, hey, Eric, either you deposit more money or we're going to close your position. That's known as a margin call. Has anyone here ever received a margin call? Jokes on you, Matthew Hardy. I've received a margin call once. I remember it to this day. It was 1995 or 1996. I was in the shower. I was living at home, and I get out of the shower and I'm drying off. My mom comes in and goes, it's the phone for you. It's Lynn Waldock, the broker I had. She's like, I got off the phone. She's like, what was that? Your face was all white. But that's what a margin call is. Kirk, thank you for your time.
Thanks, everybody.
So the reason this is standardized, well, when something is standardized, the costs are lower and lower. The banks, the CDS market could have been like this. And that was, I mean, this is something I pointed out at the time and before. This was a huge risk. But the banks didn't want standardized contracts because then the amount of money they make on it would have dropped dramatically. What the CME should have done is gone and find out what are the top 200 CDS contracts, and then they should have just offered derivatives on them and let people trade them. And then you and I could go and buy derivatives. Hey, do you think Ford is going to go bankrupt? Here's a product. This is the payoff. And they could charge margin on it and do all kinds of stuff and standardize it. And then the CDS market would have been even bigger. But you wouldn't have had this risk. I don't know if it was in the movie, but you know Ryan Gosling's character, the Deutsche Bank guy? Basically, he had a trade with Morgan Stanley, not Steve Carell's group, but like the main Morgan Stanley group. And they were disagreeing on the valuation of the product, because what they would do is periodically they would say, okay, the price is now this, you have to send me money because you're losing, or I have to send you money because I'm losing. And there is a dispute over that. And if you read the book, Ryan Gosling's character is like, you either, like, the price is at 80 now. And Morgan Stanley's like, no, it's at 100, it's 100. He's like, no, it's 80. So you either buy more at 83, you sell it at 80, or you send me effing $10 million. And that was what he told them, because there was no central clearing party. This was all done directly. DeFi, OTC, whatever you want to call it. Whereas with an exchange, it's like, okay, the margin requirement is now, it used to be X, now it's larger. And then they'll, even something that's not very liquid. So what are we looking at here? The whiteboard. Let's look at this. I'm short these. I'm not short this one. But something like this is very illiquid. It doesn't trade very much every day. But the exchange will still set a value on it, and that's what everyone agrees on. 429.2 is the last price. And that's one of the other benefits of a centralized thing. Okay, this is the official last price. And if you don't like it, well, then you buy it or sell it. You do what you think is right. But that is the last price, and your margin and such are going to be based on that. Questions on this? I'll do that meme after we get out of class. Should we just keep going for another half an hour or so and then and then finish?
Yes,
Is that okay? Since
I want
we're-
to push through.
What other questions do you have on this before we go and talk about put options? Anything else on the DeFi and centralization? Look, I mean, I'm a libertarian, so I'm like anti-government and all that, but I still see massive benefits to centralization, especially with stuff like exchanges, because it makes it so much cleaner, so much easier. And then it's the exchange's job to manage the overall risk and say, hey, Robinhood, your customers are buying too much or selling too much or whatever, you have to deposit more money at the exchange. Because if Matthew goes bankrupt, Robinhood has to make up the money to the exchange. If Robinhood goes bankrupt, the exchange will still honor the contract that they have with me. Questions? No? All good? Okay. I'm going to clear this. Can I clear this? All right. Now, we are going to talk about the other type of option, which is called what? We'll stick with unleaded gas. Is that okay? Something that everyone's familiar with. Now, Matthew, okay, so Willard, so basically you're asking like, okay, so I don't think I have it saved anywhere, Willard, good question. So I trade with Interactive Brokers. Interactive Brokers gives you a warning before you breach your margin. And then they basically say, hey, look, we don't issue margin calls. So if you breach your margin, we just start closing positions. So I was, I got this Russian band. I spent the day like stripping off the rust and doing all this stuff. So I was really busy. I had trades on, and then the market started moving. I wasn't paying attention. I had bought some options for 5 cents. And the market moved, and one of the things moved massively in my favor. And I went and checked later on, and I was like, oh, I thought I had more options than that. What am I missing? And then later, after I was done doing all my stuff, I looked, they had sold some of my options because I breached my margin. So there, Willard, they don't actually issue a margin call. They just go in and start liquidating. Now, the funny thing is they sold the options at like the high of the day at like 38 cents. I was like, wow, man, I'm just going to let them trade for me. They do a better job than I do. I sold some at 18 cents and they sold them at like 30 something cents. You'd have to check with your broker. I don't know how each broker is different. I've had margin calls before, like I said, but Interactive Brokers, they're like, we don't issue margin calls. We just start selling positions. I don't know how they determine what they sell. There's got to be some calculation, but I don't know. Other brokers, it might be a bit more lenient. So now let's look at all right, where are we? Gasoline quotes June 2023 options. Now, I think it's going down. So I'm going to buy the $5 put. For a call, think of you call it away from the person. A put, think you put it to them. So Matthew, still here, Matthew? So let's say the 250 put, we'll call it $5. So we'll say June 2023, $5 put costs, we'll just say again, 50 cents. Now, let's start. Oh, sorry. No, you don't need to see it. I just looked it up. Hold on one second, sorry. Okay, there we go. There's my whiteboard. Now, I am the put buyer. Matthew is the put seller. Who has the right? Who has the obligation? Who received money? Well, Matthew's the seller. When you sell something, you receive cash for it. So yes, Richard, Matthew receives 50 cents. Eric pays it. So who has the right? The buyer or the seller? The buyer. I have the right. What do I have the right to do? June 23, $5 put.
Buy it at $5.
Not to buy it. A call option, you have the right to buy something. A put option, you have the right to sell something.
So sell the gasoline at 5, even, or if it goes at 5.20 or above.
$5. It's a $5 put this time.
Oh, it's a $5 put. Okay,
Just because I looked and that was about 50 cents.
right.
So I have the right to sell Matthew gasoline at $5 a gallon. When would I want to exercise that right?
Well, at 5, wouldn't you? Or
If gasoline is at $7 a gallon in the market, am I going to sell it to Matthew for 5?
5? No.
If it's at $3 a gallon in the market, am I going to sell it to him for 5?
Well, you would like to,
Yeah, well, I mean, I bought a put option, so I have the right to do it.
right?
Am I gonna sell it to him for $5 when the market price is $2 or $8?
$2.
Yeah, 2.
Oh,
If it goes down to $2 and I have gasoline to sell, I can yell, hey, Matthew, remember that contract you signed November 16th? Whap, here's a bunch of gasoline. Give me $5 a gallon for it. Is he gonna be happy about that? That he just had to pay $5 for something that he could have bought for 2? No, not at all. So let's start graphing our payout. Minus. I am the buyer. What is the most amount of money I could lose? $0.50. Do I lose the most when the price goes up a lot or down a lot? Well, if it goes up to $10 a gallon, I'm not going to sell it to, oh wait, it's not 5.20. If it goes to $10 a gallon, I'm not going to sell it to Matthew at $5, am I? I'll just sell it in the market if I have gasoline to sell. So if it goes up to $10 a gallon and the contract expires in 30 seconds, what do I do with it? I have the right to sell gasoline to Matthew at $5. In the market, it's $10. Am I going to sell it to Matthew for $5? No. So what do I do with the contract? Yeah, I let it expire. I tear it up. I throw it in the trash. I burn it. I frame it, whatever. My max loss, as we said, is 50 cents. If the market price is $8, what do I do? Still nothing, still nothing, still nothing. Where does my behavior change?
under 5.
Exactly, at $5, which is the strike price. Now, at $5, my P&L looks like that. Well, I had to pay him 50 cents. What is the break-even point? If gasoline goes to 0, they're literally giving it away for free. I go to Matthew, I go, hey, remember that contract? You have to pay me $5 for a gallon. Exactly, Willard. The break even is the strike price minus the premium. K minus P is the break-even price. For the premium here is 50 cents. The strike price is $5. What is the max gain? Is it unlimited? Can heating oil go below 0? That's also K minus P. $4.50 is the most I can make. Now, actually, crude oil did go negative 2 years ago. I've been in the futures markets almost 30 years. I'd never seen that. I did not know that could happen. But it does make sense that it could happen for certain commodities. Above the strike price, I let the option expire worthless. If gas is $10 a gallon, or we'll say $8 here, I'm not going to sell it to Matthew at 5. I would just sell it in the market at 8 if I had it. As gas goes below $5, I now benefit by selling it to him at $5. What is this trade called? This position? This is a long put. Long because I purchased it. Put because it's a put option. I have the right to put the gasoline into Matthew's garage or car or barge, and wherever he's going to take it. Questions on this? Was there silence? No questions? Everyone's brains are fried after 2.5 hours of options and credit default swaps? Oh, we're taking notes. Okay, that's good. Questions on what do I want to happen here? I bought a put. What do I want to happen to the price of the underlier? Exactly. I want it to go down. And the more it goes down, the more money I make. Let's look at Matthew. What does his graph look like? And this is where it's a lot more fun to have the class in person, because then I have people come up and draw the graphs on the board. And last night, 4 different students came up and then drew them, and they did a great job. What's the most Matthew can ever make? Yeah. What would we call this position in the red? Short put. What do we think of this? The loss potential, the gain potential are not unlimited if we assume that 0 is the lower bound of the price. Again, crude oil went to like negative $50 a barrel or something. What's $1, Willard? What do you mean?
So the strike price would be basically like $5.
Yes.
Are we?
Yeah.
Contract would be $5.
Oh, Willard, you're talking about the difference here. No, I don't understand. Okay, yeah, so 50 cents. If the gas price goes up, Matthew makes 50 cents, I lose 50 cents. Matthew makes 50, I lose 50. Here we both break even. Now I'm making money, and as much as I make, Matthew loses. So it's the exact inverse. If I make $50, he loses 50. Well, here it would be for 1 gallon. If I make $2 per gallon, he loses $2 per gallon. It's a zero-sum game. The only way for me to make money is for Matthew to lose money and vice versa. And I'm sorry, who had a question there? I think I interrupted somebody. What questions do you have on this? Remember, the options only bend at the strike price. These are something like 20 to 30% of all options traded in the US are Tesla. All stock options are Tesla. It's absolutely insane. So what we're going to do is you guys are going to do some stuff at home. I'll help get you started. And I want you to draw this garbage. So this is the main expiration, the 3rd Friday of the month. I want you to draw the P&L graph, profit and loss graph for buying the Tesla Deck 16 2022 $200 call. Can you guys do that on your own? Feel comfortable being able to do that? I'm going to give you 5 minutes, 10 minutes, and you can draw that. And then we can go over it in class and you tell me what you think. You agree with what I've drawn? Silence? Yes, you guys working on it? Okay. I'm going to run to the bathroom. I'll be right back. No. Anyone have questions or need help? Anyone done?
Can you scroll up a bit so I can, or we can see the listing for the titles for the columns? Because or it's okay, bid S. Okay, so so it's a $200 strike price. Okay,
Exactly. So which one is it?
it's that one. Yeah.
Yeah.
Okay.
So what's the premium on that?
That's why the scrolling. I think it's an 8. Is it the first column?
Yeah.
The 830.
Oh, you couldn't see the column titles.
Right, and I saw the numbers. I was trying to ascertain what, because there were some of them were close to each other.
Okay. Yeah, sorry. So
I don't know if you could do a split screen so we can see the column and at the same time this part.
say that again.
You know, the split screen, the horizontal split, so we can see the column listing at the top and then see this part on the bottom half. The split screen.
How do you do that?
I think it's under view under your, but this is at the website. So, but I think it's under view and then let me see. I have to figure.
It's okay. It's okay.
Yeah.
The premium you can
Mhm.
put as 830 or 840 or anything like that. You don't have to worry about these numbers here. So this is the strike price, $200. And this is the premium, $8.30.
Got it. Okay.
There you go. Premium 830 for deck 16, 2022, 200 call. Tesla deck. Anyone done? You want me to graph it? Or you guys need a few more minutes?
Yes, please.
All right, let's just, yeah. Okay. What do we, I guess I could have done it easier than that. What's the premium? First of all, what does the graph look like? Okay, so the premium is $8.30, and we'll use this for our strike. Premium is $8.30. Are we buying the option or selling it?
Fine.
buying it. So someone tell me what the graph is going to look like.
We'll be working in the upper half. Well, yeah,
Let's do a different way. Is it going to be the blue line or the red line?
oh, it's gonna be the blue line.
It's going to be the blue line. Okay. So it's going to look like that. It's going to go across and then it's going to go up. How far down do we go to start our line?
The 830 mark.
Okay, so we go to 830 and then what? Then it goes across
Horizontal.
and where does it bend?
Right at the strike, the 0 or O, right there.
And what is the dollar value of that?
Yeah. Yeah. 200 strike price.
200. Okay. Okay, so let's start labeling some points. What is the dollar value of this here?
The 830.
Minus
Negative
8.3.
830. Yeah.
What is the name of this?
Well, that's a premium.
Okay. And that equals what? $8.30,
Right.
which is the max loss. What is this point? What is the dollar value? And then what does the point mean?
That's K, or the strike price. 200.
What is this?
Break even.
And what's the dollar value?
Well, 830 or 208. 30.
208.30.
Right.
If you were to purchase this, and then what is this? Well, we would say Tesla share price. That's the x-axis. The y-axis is your profit and loss. Above 0 here is a profit, below 0 here is a loss. So if you were to purchase this option for $8, this would be your payoff, and you would just say, okay, what is the final share price of Tesla? 150 bucks. What's your P&L at $150?
Well, nothing. At
So
150.
it's zero.
Boy, say again the question.
At $150, what is your P&L?
Negative 830.
Yeah. Exactly. You lose $8.30. If I were to say at 220, what is your P&L?
Well, 220 minus 830. So whatever. What's that? 1170 or yeah, 220 minus 830.
So what's that? 1170?
Okay. 220 minus
because you can say, oh, well, I bought the stock for $200, made a $20 profit, but I had to pay $8 for the option, or $8.30 for the option. So the total profit is $11.70. Who feels comfortable doing this? I mean, it's what I would do when we're not going to have the exam next week because it's right before Thanksgiving, and I think some people are going to be gone. So we'll do it the week after. We'll do options. We'll talk about real estate next week as well. Who feels comfortable being able to do these things? If you take this class in person, you have to draw some of these options and then label all the relevant points. Should I do a homework like that? Graph these two options and then take a screenshot and, for future classes, do you think that would be useful? Practice doing those things. If anyone has a Robinhood account, my fiance does, they have pretty good education for options, but I can totally see why people have a problem with Robinhood because it's like a video game. Oh yeah, this is fun. Let's do this. Oh, do this and that. It's like, this isn't meant to be a video game, right? So Orlando, what do you mean? How can I help? What did you struggle with on this? Anyone have questions with this graph? Oh yeah, so am I. When you should see when I draw this in person, it's like someone with Parkinson's was drawing the line.
So
That's why I like the whiteboard because it's. Go ahead, Orlando.
So pretty much the way the label is, we just break it down from the label, right? Like if you were to just spit out the data like how you did just earlier in a bit.
What do you mean? Are you talking about like how I would ask the question on an exam?
No, I mean, like I should just be able to draw the map just with this information alone, correct?
Yeah, 100%.
Okay, so I gotta remember that because then like when you give the examples at a loss, I'm expecting there to be some kind of example with it, not just that information.
Say that again.
So, okay, when you're making this map, for some reason, I'm expecting there to be an example. So later on, you gave us the examples. What would the profit and loss be at $150?
Mm-hmm.
So I'm expecting there to be, an example of losses. So I somehow I got to remember that.
I mean, this once you understand how an option works and the payoff, all you have to do is plug in the final price of Tesla, and then you can calculate what your actual profit or loss will be. So the information that you get from the actual NASDAQ website right here, well, that's enough information to tell you what your P&L will be. You just have to put in what's the final price of Tesla going to be.
Yeah, I would have to practice it because when I originally did it, I did it like this. Wrong.
Let me see. Hold on, give me 1 second. Keep that up there. Let me pin that and okay, so okay. Yeah. Okay. Look, it's not easy, it's not intuitive. That's why you practice that, and if you go and if you look in the slide pack here. These are the examples. This is a long call right here. This is the short call. Well, this and this always net to zero. This is a long put. This is a short put. This and this always net to zero. And I think the easiest thing to do is start with a long call. Because that is easier, I think, for most of us to understand. Juan, you want to do a put?
Yeah, sure.
All right, December 16th, $200 put. The premium is, we will call it, let's just call it $20. So deck Tesla, deck 16/20/22, $200 put for $20 premium. Oops, I wrote 300. That's supposed to be 200. Apologies. $200 put.
So these are long puts.
Yeah.
How can you tell the difference between a long?
Well, no, we're just saying which, these are the puts
Okay.
over here. These are the calls.
Okay.
So if you buy a call, then you graph the buy call. If you sell this call, then you graph the opposite. So I'll give you guys a couple minutes. And then we can graph. What do we think? We ready? Yay, nay? What's the most you can lose if you buy this put option?
$20.
$20. What do you want the stock to do?
Go above the strike price.
With the put option, do you want it to go above the strike price? Orlando?
Lower?
You want it to go lower. You get paid if it goes down. So if the stock goes to the moon, you lose your premium, and that's it. Where does this bend?
$20.
Is that where it bends?
Oh, I thought ends.
Options only bend at the strike price. What is the max loss?
That is $20.
That's the most you can lose. If the stock goes to $500 or back to $1,000 a share, you only lose $20. What is your break even?
$2.20.
Close. It's not the strike plus, it's not the strike price plus the premium.
180.
$208.30. Oh no, minus that. So the one.
So it's the $200 strike price minus the $20 premium you paid. So the break even for the put option is right there. What's your max gain? Well, you can sell it for, if the stock goes to zero, you can sell it for $200 a share minus the $20 you paid for the option. What questions do you have on this? What do we think?
This is very fascinating.
Next week, do you guys want to try some group work? I'll break you into groups of 2 or 3 and let you do some of this stuff.
Sounds like a good idea.
That's a good idea, yeah.
Okay. Yeah, that's what we do in class. I've never done group work graphing options on Zoom yet. So I don't know how it'll go. It might be tough for people to do that, but yeah, let you guys have a crack at it and see how it goes. That's how we learn what works and what doesn't. Anything else? This interesting?
It's very interesting.
Options. So, we'll do this more. We'll do it more next week. We'll talk more about why you would use options and the positive and negative of using options. And comparing that to, hey, I have a view that I want to express. I think Tesla is going up. You could buy stock. You could buy a call. You could sell a put. You could do all sorts of different things, and they all have different positive attributes and negative attributes. Why, what, Karen? Oh, no, I mean, that's, I'm not saying I believe that, but I'm saying if you believe Tesla is going up, okay, now there are different ways to express that view. I'm thinking when your mom comes in and says, what are you doing? Are you gambling all your stimulus money? And I go, no, Mom, I'm expressing a view on Tesla, obviously. She's like, oh, okay. I thought you were gambling, buying options. No, nothing like that. Buy calls. Whatever your view is, there is a way to make money off of it. If you think Tesla's going up, if you think Tesla's going down, if you think Tesla's not going to move. Options sellers thought natural gas wasn't going to move. And they made money for an extended period of time. I don't know how long, a year, 2 years, 3 years. And then they lost it all. You know what we call that in finance? Picking up nickels in front of a steamroller. And that's kind of what the M&A market was too. A company says they're going to buy another company, and there's a little bit left. You could squeeze a little bit of juice out of that lemon, but if something goes wrong, like the earthquake in Japan, stock's down 40%. The steamroller got you. Anything else before we go? No? Well, thank you. This is tough, kind of tough doing options like that. It's a lot easier and a lot more fun in person when everyone can go up there. It's kind of interesting. The people who don't really feel that they grasp it that well, when they get up at the board, they usually are able to get it right. It's kind of interesting because they're there and then they draw it and they're like, no, that's not right. And they'll erase it and kind of walk through it. And they actually need very little help from me or the class. Nearly, I think everyone who came, probably 6 or 7 people came up to the board last night, and everyone got their option right. There were different options and stuff like that. So it was pretty good. But we'll play around with that next week. Anything else?
Professor,
Uh-huh.
I was going to ask, I know this, like options and puts, they're a little bit on the speculative side to me, and I was kind of sort of commenting on that in the chat. I much rather look at it as stock and look at the sort of fundamentals and do any kind of analysis that we can to determine, whether that the risk level is more, I wouldn't say guaranteed, but just make you feel more comfortable, depending on for those who have a very low tolerance for risk. Are we going to cover anything like that in this course, to go over like analysis of the stock besides everything that we have so far?
No, we're not. We don't really have much time to do fundamental analysis on stocks.
Mhm.
You know, we can talk about that a bit more, especially as it gets towards the end of the semester, but
Mhm.
using options is not, what do I want to say is not antithetical. I don't know if antithetical is the right word, but it is not mutually exclusive. You can do fundamental analysis and say, I have done fundamental analysis and I think this stock is going up for my
Or down.
reasons, whatever reasons you have. Now you have a view. The stock is going up. How do you want to express that view? You can buy stock. Okay. And I will just, you know, quickly while we're here, and I've got you, let me show you. You think the stock is going up. Okay. So where's Tesla right now? Anyone know?
I think I saw it was like 180 last check, but I'll
180, yeah, okay, 187.
yeah.
So that's 200. Green is long Tesla stock, where these have the same slope. Obviously they don't, because I'm as artistically challenged as you. I think that was you that said that, right, Huma?
Correct.
Right, so yeah, I'm as artistically, does that look like they have the same slope? The green and the blue lines? Probably not. Let's go
Good enough.
back. Right, are those lines parallel? Yeah, let's say they are. Okay, so now the current stock price, say market price, 187. That is your P&L graph, the green line, if you just buy stock. What is your max loss on the green line? You buy one share for $187. What is the most you can lose?
Your premium?
Sorry?
Would it be your premium?
No, Willard? $187. You buy a share for $187, it could go to zero.
Oh, you're talking about regular, regular
Yeah.
trade.
The green line. Well, if you buy this option for $8, the most you can lose is $8. And obviously I haven't drawn this to scale, but there's a huge difference between losing $8 a share and $200, or sorry, $8 and $187 a share.
Right.
Now, if the stock by mid-December goes here, which we will say $195, well, in the green scenario, you make $8. In the blue scenario, you lose $8. So this is just a function of where do you see the stock going and in what time period. If you think the stock is going to 250 by December 3rd, just picking a date at random, and you have $200 in your account, should you buy one share or should you buy 20 options?
I'm sorry, the beginning of it, you were saying if you believe it's going what?
If you think the stock is going to go to $250 by December 10th, and you have $187 in your account, you can buy one share of stock. And if it goes to, what do we call it, 225? Well, you make $38.
Mm-hmm.
$38 on an investment of 187. Okay, that's pretty good. But you could buy literally 10 options. If you were that convinced, and you would make, what did I say it was? Call it $17 times 10, you would make $170 instead of 38.
So you make more and you lose less?
Exactly. But you have a time component, and that is what you give up. If Tesla goes down all through December and then rallies in January, well, you'll make money in the green scenario and you'll lose money in the blue scenario.
But it's fundamentally more like a bet than the traditional stock purchase, right?
And I mean, you know, what is a bet? I don't know the definition of a bet versus.
You're saying you anticipated doing something by a certain time that might be a lot shorter than someone that's playing very long, like myself.
Mm-hmm. Yeah, look, if you're, and you know, options are certainly not for everyone. And if you're like, hey, look, I go to school, I have a job, I have a family, I have a bunch of stuff to do, well, then you shouldn't be in options.
Mm-hmm.
Because those are the kinds of things where you need to spend time looking at it. If you go, hey, this stock is at 187 bucks. I think it's going to be the dominant car company in the next 5 or 10 years. I'm going to buy the stock and forget about it. That's totally, totally defensible.
Right. Right. Or if you look at it from, I like to look at investment mostly from real estate, which obviously has done well over years. And I guess that's the kind of framework by which I come to the stock market. Maybe not necessarily in line with what we're talking about today.
Meaning you prefer real estate?
I prefer I won't say speculative nature of this, but like the fact that when you purchase real estate 30 years ago compared to today, you know that it's going up. And if you were to do so now on the same basis, even though we are making a bet that it will go up, it's pretty almost commonsensical to think that it will go up in 20 years from now when you purchase something.
What, real estate or stocks?
Real estate.
We'll see. We will see. I mean, you look at the Case-Shiller index. Is there an upper bound to real estate prices?
There's always a cycle, but if you look at it from, just like if you look at S&P 500 over 1929 onwards.
Is this going to go up over the next 10 years?
You mean the end point?
Well,
I think
we're at 404 in the Case-Shiller LA index. In 10 years, is that going to be higher?
I think so. I mean, wages always go up. Everything goes up. Standard of living goes up. Milk never cost.
No. The standard of living has been going down for 20 years.
Standard of living?
Yes, the standard of living has been going down for 20 years at least.
I guess what I mean is
home prices have gone up in nominal terms.
Right.
That is true.
But I mean, like
living has gone down.
Right. Your gallon of milk has gone up. Gasoline has gone up. Everything has gone up. Obviously, our standard of living has gone down as a result of that. Right.
Look, I'm not saying it won't be higher in 10 or 20 years. I think it will be.
Right.
I don't know that that's the best investment, but it depends. Every time I've had to buy real estate, I couldn't use leverage. Because when did I buy real estate here? No one would lend money. So, then I bought my other place here. I couldn't get a loan because I didn't have a job. So that I think what people forget is that a lot of the juice in real estate comes from the fact that you only have to put 3, 5, 10, 20% down.
Right.
If you could have purchased stocks here and put 5% down, oh, well, I've got $100,000. Oh, okay. Well, you can buy $1 million worth of stock. You can buy $2 million worth of stock. Well, you would be absolutely, well, let's go to the S&P chart.
Not to mention, you can also benefit from other people's money through rent.
Yeah, but I mean, look, I think I told you guys, my ex bought a place in North Carolina a few months ago. She loses money every month on that.
Hmm.
You know, that's to the best of my knowledge, that's unheard of. I mean, even people who were buying homes in, well, I don't know. I'd have to actually do the math. Maybe not. Because you were buying a house here. So I'm thinking of my 1-bed condos went for 280. I need to think about that because I know what the rent, hold on, we can knock that out next week when we start talking about real estate. The rents were, what were they? 1,200, so 2,000 divided by 300,000, 4.8%. So, yeah, that you would have made money on that, I think. You know, not a lot, but you'd have had a positive return on an unlevered basis. But once you started borrowing money, you were on negative cash flow, which is, I think, her situation. So
She's paying more than she's getting.
I'm sorry.
She's paying more in terms of her debt service than she's getting from rent.
Well, it's not just the debt service, it's the property taxes and maintenance. And,
Right.
you know, she has to pay a manager 10% of the rent. So that plus the debt service, yeah, it's now cash flow negative to the tune of, I don't know, $500 a month.
Right. There's a certain degree of that you can kind of control by, doing your rent surveys, doing your estimates, finding out what rent goes for, how much down payment you put to bring your payment. Like it's so much more controllable than I think stock investing is or options trading because you don't control what can happen in the market. There are other market makers that can move the market, just kind of like what we talked about with FTX. There are certain things that can happen that you unfortunately don't have any control over.
Yeah, that's true. But I mean, that's the real estate market too. I mean, what don't you have any control? I was telling my class today. Somebody tweeted or put on Instagram or something. They go, yeah, it's nice owning your own home and all, but homeowners will never know the joy of pouring hot bacon grease down the sink. And I was just like, oh, that's so sweet that my tenants are out there posting on Instagram. Because that's what happens. Right? And I love having these in-person classes. And then I go, okay, everyone who rents, raise your hand. Almost all the class raises their hand. I go, everyone who thinks you're a good tenant, raise your hand. Everybody raises their hand, right? And I go, everyone who's called their landlord to fix a problem in the last 4 months, raise your hand. 2/3 of the hand go up. I said, if it was related to the kitchen sink or the garbage disposal, raise your hand. It's happening. If it was related to a toilet, and that's what it is, right? It's toilets and sinks, right? Well, yeah, people put cement down the pipe, bacon. Oh yeah. I just had a flood in one of my units. I think I told you guys about. It wasn't a flood, it was just a pipe that leaked, but it was, I'm out $2,000 out of pocket. Insurance paid $7,000.
Mm-hmm.
My tenant's like, oh no, they didn't want to move out. They have renter's insurance. So they're like, oh, well, we couldn't use the whole kitchen, so we want 3 months of free rent. I was like, well, you guys have renter's insurance. Why didn't you use that? Well, we didn't want to. I'm like, okay, well, I'm not your insurer. Right? So I'm not going to, make you whole on what you think you're owed because you're not owed that. So yeah, no, I mean, landlord, look, this is the interesting thing. You look at this Case-Shiller index, that's where it is now. So let's look at the San Diego one. Well, else the LA will probably be the same. So Los Angeles Case-Shiller future Feb 2024. So this is what's interesting. That's the dude who. Here we go. Computer's like ready to die. So this is interesting. Walk me through this. And I actually have to talk to my buddy Ian about this. So data. Markets. Okay, any manage those options. Suite of products. So what this is a future on the Case-Shiller index, and it cash settles to the index value. Oh, they're coal futures. Oh,
Are you just looking for general real estate, or are you looking for Case-Shiller
no,
future?
this is an actual futures product. Here we go. Metro Index housing quotes. So here's something to chew on. This is the Case-Shiller 20. All right, real estate. Here we go. Okay, here we go. All right, Boston, Chicago, Denver, Vegas, LA, Miami, New York, San Diego. So I'm short the San Diego one. So let's look at LA. And why can't I click on it? Damn it. Oh, they have an LA gasoline. Oh, so this is the spread of Los Angeles gasoline over New York. That's interesting. Case-Shiller futures. So I'm sorry, what I'm trying to figure out is, let's look at the San Diego one, because that one I actually have the data. So Case-Shiller San Diego index. Okay, so what this is, 400. So today it's 400 spot 50, we'll call it. Feb 2024, it's priced at, let me see, I've got it on my thing here. 335. So that means the market is expecting 400 minus 335 is 65 divided by 400. The market is expecting a 16% decline in San Diego house prices between today and February of 2024.
So where are you getting that?
So this is the current Case-Shiller index for San Diego, 400.46. And I have here, I'll show you on my system. Let me turn my thing on. You see that? C335.00. That is the San Diego February of 2024 Case-Shiller index future. So whatever the Case-Shiller index, this thing here that I'm showing you on the internet right now, you see
Mhm.
this number 400.46? Whatever that settles at the end of February is what this index will set to. And then if you sold it at a higher price, you make money. If you bought it at a lower price, you make money. And if you did the opposite, you lose money.
Mm,
So what that means is that the market is pricing in a 16% decline in housing prices between today and February 2024.
it's pretty
Yeah.
foreseeable.
Sorry,
I think that's foreseeable based on where we've.
it's a year and a half in a way, like interest rates are up, et cetera, et cetera. But think about it. If you want to buy a house today, you have to pay today's price.
Right.
And you're probably going to get net negative cash flow at least for 1 or 2 years, maybe longer.
For you talk about for rental
Yeah,
purpose.
right. If you borrow money, if you buy, $800,000 house in San Diego, and we'll go over this next week, and we'll go
Right.
through the numbers, and you borrow $400,000 or $700,000 to do it, you're going to be cash flow negative. Why would you do that when instead you could just buy this future? Because if housing stays the same, well, you'll make what? 65 over 33.5, 65 divided by 335. You'll make 20%. If it goes down farther, so let's say a San Diego house today, we'll just say it's double the index, is 800,000. And the index is 400. February 2024. The index is 335. Wouldn't you be better off buying the future?
At 800,000 worth of it.
Yeah, maybe not that much, but maybe your cash value. So one future is $250 times the point value. So each future is $83,000. So if you did 5 of them, that's 400 grand. You'd have $400,000 worth of exposure. Wouldn't you be better off doing that? Because what happens if housing just runs up? Okay, well, you bought it at a 16% discount.
Mhm.
And you didn't have any negative cash flow for the next couple of years. What happens if housing goes down?
Even more.
What happens if housing goes down 50% from today?
You still profit, don't you?
Well, no, I mean, you'll lose money. The
Hmm.
difference is if you bought a house today for 800,000 and if it's worth 400,000
Oh, the
in
house example.
2 years, you might not actually have a net cash loss. You just paid
Yeah.
double what it's currently worth. Whereas with this, you would have lost, not half your money, but you would lose 135 if the index closes at 200.
Hmm.
So I don't know. To me, it's
This is definitely a challenging market. I'm definitely not talking about in this market. You should definitely be pricing in, your discount for, let's say, like you said, 16% below what the current prices are today. That's how I would be looking at making any kind of investment in real estate property. But no,
prices right now aren't, they're like, the
Really?
price cuts. I see these homes and they're, like a million homes listed for 1.2 million and they're like $20,000 price cut. You're like, okay,
that's not enough. Yeah,
that takes it back to where the price was 3 months ago.
right. The interest rate is definitely not reflecting the discounts yet.
Yeah, exactly. So,
No,
I
I
don't
think
know.
that people know that. I think unsuspecting consumers probably don't, and the agents are not probably informing them enough of what might be ahead. But if they don't have any alternative, they're already paying really high rents. Rents are going up. They figure they want to start that process now and refinance later, which they're fully well entitled to do, assuming they're still employed,
Yeah, right.
right?
Exactly. Yeah, I don't know. This is gonna be interesting to see how this shakes out. I have no idea.
Right.
No idea. I'm trying to sell one of my places here in LA, but that's just because it's I don't want to do the work to manage the Airbnb anymore. And I used to live there, so I can sell it now. This is like the last year I can sell it and not pay capital gains.
That's right. This is the Marina Del Rey property you showed us?
Yeah.
Yeah.
So no.
Well-
Otherwise, I'd sell one of my ones in San Diego because those are so easy to sell. I could sell that in 2 days.
Are you not 1031ing it, or are you just doing it as a
No.
person? Yeah, capital gains. Okay.
Because at 1031, like, what am I going to do? Buy something in North Carolina that has a negative yield? Like, the only
Well,
thing I would do is buy a commercial property in Florida where my business is, but there's not. It's
But-
tough, so there's
I
not
mean,
for sale.
it's still not bad the way you're doing it, because you can maybe, depending on your equity, keep it, and when it does crash this time, you'll be cash heavy.
Yeah, we'll see. We'll see.
Right.
For me, I'll just put it in something, low risk and wait and see what happens. But like 70% of my net worth is in property anyway, so that's my problem.
That's not a bad problem to have.
Could be worse. When Mr. Burns and Homer were talking, and Homer goes, "Mr. Burns, you're the richest man I know." And Mr. Burns, yeah, but I'd trade it all for a little more.
When we are.
Yeah, exactly. Exactly. Hold on, Karen, how do you not pay? Oh, so Karen, that used to be my primary residence. If you live there 2 out of the last 5 years, it's your primary residence. You don't have to pay capital gains tax up to $500,000, I think, if you're married.
Million if you're married, 250 unmarried, yeah.
Yeah. So. But that's my goal is I'll probably just move into the next place and then sell that, and we'll see. We will see. Anything else, guys? Good chat, Human. Thank you very much for that. Well, this is gonna be interesting next week when we finish options and start talking about real estate. Okay, good stuff, guys. Thank you, everyone. I will see you next week. I'll finish grading your exams this week. Canvas is a bit iffy at my house, so hopefully I can get that all sorted out and finish grading your exams. But so far, it looks pretty good. So, cool. And then we won't have a quiz next week. We'll have it the week after, which is like the 29th or something. Yeah, 30th, I think. Yeah. Cool. Bye, everyone. Thanks again. Thanks for being nice to Kirk.
Thank you, Professor.